Hello, ladies and gentlemen. Welcome back to Jack Fund Management. Fed Chair Powell felt reverse repo rates, broadly a lending tool for short-term capital, were nothing disturbing. He also cited an ultra-strong labor market, coming very soon. He referred to a key point. They may adapt SLR. SLR roughly means a comparison of capital to total leverage exposure, also ascribed TLE. They feel no nerves about overcorrection or building overcapacity. MicroStrategy, ticker MSDR, with Michael Saylor, initiated a $1 billion shelf offering, simply meaning an equity issuer, in this case a corporation. MicroStrategy can register new securities, yet does not have to sell this whole issuance all at once. They have up to 3 years to do so, clenching 92,000 Bitcoins at an average cost basis of $24,000. They had a value increase of about $1.5 billion. Bitcoin has some resistance at 45,000. It even has some resistance at 40,000. For us to get more constructive, it has to surpass some key technical levels. It does not take much crypto to have diversification. They really do not have much correlation with many other asset classes. 1-2% can have material effect. We have eyes on use cases. Market participants took a bit to digest this jobs data and Fed gathering. One would think regulators would cover DraftKings pre-greenlighting them. DraftKings got picked on by Hindenburg, yet, of course, they have a short position. This betrays itself to us a bit reminiscent of Andrew Left on Shopify at around $160. Hindenburg has gone after Riot Blockchain, Clover. Wood put another $40 million into it. Jefferies has a $75 target in place. Google, ticker GOOG, will break out to all-time highs. Google has itself levered a bit more to cyclicality of this current economy. Facebook, too, snatched all-time highs, plus looks to join $1 trillion cap league. A national average of $3.20 per gallon, this positions WTI at a $75 to $76 range. $80 enters this equation as more than possible. Producers will likely lock in these prices, reaping profits. And Exxon here could do wonders. With 8.8 times FCF, $29 billion for FY 2021 looks fully realistic for ExxonMobil, ticker XOM to NAB. Fed officials have sold a good pitch. Many big market participants place some trust in this Fed. Some even advised shorting this 10-year as it ran so far so rapidly. Bullard put a dent in this rally as a bear, vocalizing hawkishly. While Jay stayed a bit dovish as a ringleader, he likely enjoys Bullard taking this heat, in all likelihood realizing he has a point or two. All pointing to growth, this further supports a FANG thesis. A lot of market mechanics have gone fiscal policy. This generally means White House money, likely to reduce with quad witching, and dates on options and SS futures and so on. This week muddled some data. Japan will entertain these Olympic Games, yet will impose restrictions. It will donate 1 million vaccine doses to Vietnam. Though lumber has backed off mildly, demand and growth in this housing sector stays in view. It still has an undersupply. Do not expect it to pass anytime soon. These home builders got burned in 2008, so will foreseeably not flood market. Realtors complain of inadequate housing supply. Oil really had and has a supercycle. A strong summer, stronger than even counted on, as Fed officials confessed. Unbridled demand likely gives Russia and OPEC happy little grins. Exxon, extending for 53.5% gains for this year, lines up with energy outrunning many industries. Oil could hit 80. If it overtakes this as a next destination, that could portend 100. While within a medium term, a twilight industry, oil demand stays extant. Over these forthcoming years, therefore, prospects look very, very good. Chipotle will augment menu prices by 4%. Around some regions, chips up 13.3%, burritos up about 11%, come due to paying workers more. To do this easily means they have a standout station of pricing power, as they feature a loyal customer base. Offsetting margins, all of this restaurant industry will surely do this. Those eateries who have taken less past price decisions, like a Darden, ticker DRI, could keep coming out far on top. DraftKings divulged this piece of business aforementioned accounts for a meager percent of revenue. Having nothing to do with customers, rather a tech stack, this unit just gave them some IP. We had FOMC drift, common parlance. Luminar works on a blade concept for integrated autonomous. Execution means almost everything. Beating or meeting milestones dictates stronger governance. An increasing rarity these days, something investors could scrutinize more. This symbolizes industry stars. This Fed framework now waits until they get ratifications. Of course, policy operating with a lag, they may overshoot. This runway on liftoff itself still puts investors on watch. US conveyed how seriously we take ransomware. Cybersecurity themes prevail. GM will spend $35 billion on electric and autonomous vehicle investments. EV ambitions stay in full force. They will make Hummers and likely Escalades next. Lincoln will electrify everything within that lineup. If you work in a different state, Goldman Sachs states you do not get paid New York rates. And we love this phrase: capital goes where it gets welcome, stays where it gets well treated. Fed balance sheet unwind, something on minds of investors, has tilted over $8 trillion as T-notes keep drifting down. We get dot plots only 4 times per year. More and more officials tilt off transitory. Despite what they say, those tags/pointers dot grant people discernment of revisions. Markets, to us, display a bit more complacency. Put-to-call ratios rest at major lows. VXX started to pick up. Inflation expectations went up, consumers surmise higher inflation. This has a powerful effect and translates into actual inflation. A path of least resistance for markets credibly turns up as higher for equities. Wage price spirals, companies repricing sales, and inflationary milieu all add to inflation and profit revenue accumulation. Someone has to pay for inflation. Not all rate hikes created equal. Once full employment mandates get met, a reason for hikes matters. A normalization path, contrasted with pushing back against inflation, surfaces as a real conversation. More telegraphing could come at Jackson Hole. Further elaboration in this 9th-month meeting. Managers realize that we probe at how, and almost more importantly, why. Supply disruptions around semiconductors could subside. 2s, 10s in terms of yield curve has moved a bit. US dollar has bounced off 2018 lines. Fed office holders noted they apprehend an unemployment figure at 4.5 by year end. A lot of meme stocks have held on to glaringly substantial gains. Nasdaq outpacing has started to come to light. Insurance businesses have started to evolve into insurtech businesses. Many of them will use technology in real time. One either uses this data, driving and behavioral, or they typically use marital status, age. Many of these incumbent insurance businesses got founded pre-1940. Even with newer safety features, distracted driving actually increases. With phones, texting, screens, we have more digital entertainment than ever. All else equal, when central banks set interest rates a bit higher, it speaks better for partially less risky assets. We see a bit of a flight to higher quality tech monikers. All of this looks more mid-cycle. Biden removed Putin. Cybersecurity technology lingers front and center. Democracies versus autocracies holds as a situation of our era. Some U.S. individuals have to divest, got barred from investing in China. We may get this infrastructure bill solidified by year end. America tries to counter China's One Belt, One Road policy. Bipartisan support arose to keep technology companies competitive and likely create more innovation. This administration will perpetuate carbon-free energy offerings. Ship containers seat themselves in high demand, not necessarily ships. Moreover, logistically, getting them to correct locations carries on as a problem. Politician Elon Musk flip-flopped once more, as flip-floppers do, saying he will accept Bitcoin, crypto, as payment upon it obtaining more renewability status. NATO will likely enact a cyber policy, as well as ban to counter some efforts of China. They also will support a climate measure, agreeing to cut carbon emissions by 2030. Still, a minimum corporate tax could undermine Europe, not benefiting them, seeing as many giant US tech corps and pharmaceuticals seek rates there. Crypto gets defined as indefinite-lived assets. Maybe Elon Musk did not realize this when incorporating it into this balance sheet of Tesla. They have plenty of losses, no reason to have an additional write-off. One cannot mark it up if it goes up, it can only get marked down based on modern classification. Getting this respecified within regulation could confer an uber positive for this crypto space, and a more factual catalyst. US deemed meeting with Putin productive for now. Some base effects have worn off. Very generally, we can describe it to you as a point by which one measures. In this case, coming off such a pandemic pit distorted some data. This brings about more inflation talk instead of sheer inflation. A sequel still lurks. Now, though, evidence points to some clarity. As we inspect and parse more data, so tech and a suppressed 10-year keeps markets inclined to big growth. Longer-term secular trends, green energy, charging ports could bode well for solid equities, reinforcing a quality thesis. A fertile ground if businesses cannot succeed even in this rate environment. We feel unsure what to say about that. 1.5 rates, nothing like a 6, 7, may actually authenticate health, even bringing some clean balance sheets to a forefront. 10-year stayed subdued, breaching above 1.5. One could calculate a 10-year in a couple different ways. One could figure it through one arrives at as an average Fed funds rate over 10 years. One could quantify this also by what markets expect for GDP. We look like we have a bit of a merger of cyclical and secular growth. As job numbers grew a bit more sluggishly than expected, This could put off rate hikes for a bit longer than first thought. This can transform though as data transforms. More dot plot projections came out a bit more substantive, showing 2 projected rate hikes by 2023. Back to what we said, all tied together, investors have full focus on growth stocks, tech, and risk on. Britain will endure another couple week lockdown due to an upsurge in some cases. Investors keep in mind that tapering does not mean tightening, as rates appear on hold until at least 2023. Blockchain and derivatives will impact commerce, global commerce, like internet output has done. By this summer, cruises could start to pick up. Gary Kelly and Ed Bastian from Delta wrestled for money for these airlines and received a top-notch rating among best CEOs, exuding visibility and upstanding transparency, something we look for in more boardrooms. Powell, clarifying on deliberation of forecasting, uttered they sometimes do not share thoughts. Later in 2023, along with copious expansion and higher resource utilization, touching upon these 18 different forecasts, they said they could see a situation where inflation could step to a juncture point of causing liftoff. Core PCE for 2022 at 1.7 to 2.5, united with a 3.5% growth year. We hadn't had a 3.5% growth year in any year from 2008 till now. They would more than welcome a 3% plus upswing any year. With productivity, R-star could transfigure. However, they may sacrifice this economy by waiting too long. So several FOMC members expect at least 1 rate lift 2022, at least 2 by 2023, in part foretokened by a median member of this 18-strong committee. This depicts that they can get surprised. Powell walked back this million-plus jobs number so rapidly. Jackson Hole could confirm some fireworks. We will keep you updated. Using a positive tone about labor, we think he used this speech to bring about some room to maneuver. He will likely have to have this flexibility. Treasuries climbed sharply on this. Still, they could not keep above 1.5 for now, stoking growth, big NASDAQ names in good shape. They adduced that this pandemic does not weigh on U.S. economic motion, bearing lesser constraints. He zealously tried to downplay this dot plot chart, showing generally use of contextualization. They still focus on asset purchases. They did not even whisper about short rates. Normal fund manager portfolio modifications could steer markets to slightly more volatility. US dollar has deeply sprung up. Powell just may get repulsed by thoughts of a taper tantrum. Fed associates signal they wait temporarily on guard for more deeply rooted, more demand pull related inflation. Many think rollback on some QE programs could not have a tangible effect on overall markets. Big tech could tackle normalcy. We heed that Powell does not have omnipotence, and they could react. At Geneva, Biden said he did what he came to do. He laid out what interests and values America has. Clothes could still hang in there, as clothes accompany services. One could play an association game. Beach, shorts, operating room, figs. By figs we mean ticker FIGS, an IPO pretty well received, which operates as a D2C healthcare, apparel, and lifestyle business. Also, as people go out, getting comments, cues from others could drive more sales. Cruise lines brandish themselves as a solid concrete play. We feel very bullish on them. A philosophical alteration did go on within Fed halls, outcome-based over outlook-based. They clarify they actually try to get some inflation. As they have this as a priority, we like some inflation-sensitive stocks. In 2013, when Fed officials tapered, markets did flinch. Then, they went on a 16% rally. Jackson Hole, 8 weeks from now, could bring something like this. Retail sales numbers started to decelerate, building materials too. Even motor vehicles and parts dealers came off by 3.7%. With bright elements, reopening brackets, especially moreover some more services, food services like Chipotle, ticker CMG, drinking places featured leaps of 1.8%. Clothing shops saw a hop up of 3%. This all came with upward revisions to that earlier report, whereby before it had gotten marked as unchanged. Economists felt a bit let down by this, even though it showcased 28% above this time in 2020 and 21% atop this time 2 years ago. All summed $620.2 billion in value in 2022 versus $526 billion just pre-pandemic, exemplifies things poised at elevated levels. Producer prices launched up 6.6% year over year, highest digits in 11 years, combined with personal care items up 1.8%. Now that people can do things, a transition sparked from all goods to things. In a very noisy period, we thought it wise to put a bit less weight than usual on each singular piece of data, instead stringing them together. Also, anyone who read any form of economics can see that consumers respond to economic conditions. With a tenet of high prices can cure high prices. Europe will now accept Americans via travel. Jamie Dimon asserted himself as a bit leery of inflation, hedging against it. Yet 72% of fund managers feel inflation has peaked. Standing as a less of a fixture in the second half of this year, a rotation back into growth commenced. More investors think we have a mid-cycle environment. When research parallel to this came out after 2008, this U.S. economy proceeded to expand for 9 more years. Lordstown may sell itself or find a partner, any major automotive outsource. In fantastic news for Boeing and Airbus, a truce, Europe and US agreed to drop aircraft subsidies. This has drug on for 17 years. Both sides claiming each gave illegal grants, levying tariffs on one another. This has now gone terminated for 5+ years. Summer volume has still kept us 16 days in a row, trading in a range, not moving more than 1% on S&P 500 indices. Calendar and seasonality represents a real facet of markets. In these upcoming next 5 years, we may subsist in a structural, secular bull market. Thank you all once more for watching. Keep it right here. We will see you next video. Join us, join Jack next time.